At 7 a.m. in Toronto, a young person checks their phone before leaving home. A bank notification appears before any message from friends. Credit card balance, student loan payment, next month's rent. For many young Canadians, the day no longer begins with coffee, but with debt. Policy interest rates have risen at the fastest pace in 4 decades. Borrowing costs climb month after month, while real incomes barely move. Housing prices remain far beyond the pace of savings, forcing a choice between expensive rent or decades of leverage. Household debt in Canada has surpassed 180% of disposable income, and young adults are the most exposed. Credit was once seen as a path to opportunity. Now it tightens around the future. This is not an individual story. It is a generational one, unfolding in a system where liquidity has reversed. Asset prices inflated, and risk quietly accumulated. The question is no longer who is in debt, but what system placed them there. The warning signs emerged long before anyone called it a crisis. Debt-to-income ratios among Canadians under 35 have risen faster than in any other age group, while personal savings rates have fallen to historic lows. Credit card interest exceeds 20%. Student loans are repriced under tighter monetary conditions, and rents in major cities rise at double-digit rates. Everyday liquidity is shrinking. After housing, utilities, and interest payments, little remains. These patterns resemble the pre-crisis phases seen elsewhere. Consumption sustained by borrowing, growth driven by asset values, and confidence that the cycle will correct itself. But financial systems do not run on optimism. When the cost of capital rises faster than income, debt stops being leverage and becomes structural weakness. The crisis does not arrive with a crash, but spreads quietly bill by bill, payment by payment, delay by delay across the lives of young Canadians. To understand why young Canadians are sinking into debt, one must examine the mechanics of the recent economic shock. For over a decade, ultra-low interest rates distorted financial behavior. Cheap money encouraged borrowing and pushed asset prices, especially housing, far ahead of productivity. When the Bank of Canada reversed course to contain inflation, borrowing costs surged, but income structures did not adjust. Variable rate loans were repriced, bringing future risk into the present. System-wide liquidity tightened, while consumption. Expectations remained anchored in the era of cheap credit. The shock was not interest rates themselves, but the speed of their change. Financial history shows that risk concentrates during rapid transitions. Young people, with limited assets and thinner buffers, became the final absorbers of this adjustment. Housing sits at the center of the debt spiral facing young Canadians. For years, home prices outpaced median incomes, transforming ownership from a living goal into a speculative asset. Young buyers borrowed more, extended amortizations, and accepted interest rate risks simply to stay in the market. When rates rose, prices stalled, but the debt remained. This is the danger zone. Assets stop appreciating while liabilities persist. Similar dynamics appeared in the United States before 2008 and across parts of Europe afterward. Canada's banking system is more resilient, but the burden has shifted to households. For young Canadians, a home is no longer a refuge. It is a long-term financial constraint, shaping decisions for decades. As housing and consumer credit tighten simultaneously, risk begins to ripple outward. Market indicators reflect this quietly. Credit default swap spreads widen modestly. Long-term funding costs increase and lending standards tighten. The Canadian dollar fluctuates with commodity cycles and US monetary policy, raising import costs and eroding purchasing power. Young Canadians face a double squeeze. Real incomes fall under inflation, while interest expenses climb. History offers parallels. During the Asian financial crisis of 1997, private debt expanded before currency pressure and liquidity reversals exposed vulnerabilities. Canada is not facing an immediate collapse, but the pattern is familiar. When systems remain stable, adjustment. Costs are often absorbed by those least able to bear them. Global comparisons clarify Canada's position in the cycle. In 1997, the IMF documented how Thailand and South Korea saw private debt surge under cheap capital before exchange rate shocks shattered confidence. Argentina repeatedly entered debt. Spirals as spending outpaced value creation. Greece endured a lost decade after credit masked structural weakness. Canada differs, no currency crisis, no sovereign default, but shares a reliance on asset-driven growth. When that engine slows, young people, lacking accumulated capital, suffer first. These global examples show that crises rarely begin with dramatic events. They begin with repeated financial decisions, encouraged by systems that reward borrowing over saving. At the macro level, youth debt feeds back into Canada's economy. As income is diverted to interest and principal payments, consumption weakens and growth slows. Businesses face softer demand just as higher capital costs delay investment. This negative feedback loop is well known. High debt suppresses spending, which slows growth, making debt harder to service. Personal insolvency rates have begun to rise among younger cohorts, even as banks maintain strong capital ratios. The risk is not on bank balance sheets, but household ones. When households weaken, the real economy cannot sustain momentum. The generation expected to drive future growth instead becomes a structural bottleneck. Policy responses follow rising social pressure. The Bank of Canada faces a difficult trade-off: contain inflation or ease debt burdens. Higher rates cool prices but strain households. Governments respond with rental support programs, adjustments to student loan terms, and efforts to expand housing supply. But fiscal tools can slow cycles, not reverse them. Experiences in Greece and Argentina show that once debt becomes embedded, short-term measures only buy time. Canada's challenge lies in balancing financial stability with intergenerational fairness. If policy protects systems, but not people, young Canadians remain the shock absorbers. And when a generation's confidence erodes, the cost is measured not only in GDP, but in social cohesion. At a deeper level, the issue is not just high interest rates, but income structures lagging behind living costs. Productivity growth has slowed while housing, education, and financial services costs accelerate. Real wages, after inflation, remain largely flat, while debt obligations are priced against global capital markets. This mismatch matters. Debt adjusts to global rates, income does not. As liquidity tightens, young people cut long-term investment skills, entrepreneurship, family formation. Individual choices accumulate into macroeconomic consequences. History shows that when a generation is trapped in debt, economies drift into prolonged low growth. This is not a sudden crisis, but a slow erosion where time itself becomes the greatest adversary.